This slide presents the cover of Teladoc Health's first quarter 2026 earnings report. It serves as a crucial starting point for understanding the company's latest financial performance and future outlook. I hope this detailed analysis will provide a deep understanding of Teladoc Health's current business status. This slide presents Teladoc's key financial indicators. For the first quarter, revenues stood at $614 million, a 2% decrease year-over-year, indicating a slowdown in revenue growth. The net loss per share for the first quarter was $0.36, which includes restructuring costs. Adjusted EBITDA remained flat at $58.2 million, unchanged from the previous year. Looking ahead, the outlook for FY26 annual revenue is projected to be between $2.481 billion and $2.576 billion, with the second quarter revenue expected to fall within the range of $597 million to $626 million. The projected net loss per share for FY26 is between $1.05 and $0.75, with the second quarter net loss estimated between $0.30 and $0.20. The adjusted EBITDA outlook for FY26 annual is between $267 million and $306 million, and for the second quarter, it is projected to be between $55 million and $67 million, suggesting a potential for gradual improvement in the company's profitability. Let's first examine the first quarter consolidated revenue and adjusted EBITDA figures. The left graph illustrates the revenue performance, showing $629 million in Q1 2025, which decreased to $614 million in Q1 2026, a reduction of approximately 2.4%. This indicates a slowdown in revenue growth compared to the same period last year. The right graph presents the adjusted EBITDA. It increased slightly from $58.1 million in Q1 2025 to $58.2 million in Q1 2026. The fact that EBITDA saw a slight rise despite the revenue decrease suggests that cost control measures or efforts to improve profitability were in place, which can be interpreted as a positive sign. Let's examine the performance by segment. First, the revenue for the integrated care segment started at $389 million in the first quarter, grew to $409 million by the fourth quarter, but saw a slight decrease to $395 million in the first quarter of 2026. Meanwhile, adjusted EBITDA consistently increased from $50 million in Q1, reaching $65 million in Q4, but fell to $56 million in Q1 2026, showing a trend of decline alongside revenue. Next, the BetterHelp segment's revenue showed a gradual decrease from $240 million in Q1 to $233 million in Q4, further declining to $218 million in Q1 2026. Its adjusted EBITDA also dropped significantly from $12 million in Q1 to $4 million in Q3, before rebounding to $18 million in Q4, but then plummeted to $2 million in Q1 2026, raising concerns about margin improvement. The continuous decline in revenue and sharp drop in EBITDA for the BetterHelp segment are aspects that require close observation from investors. This slide details the first quarter 2026 revenue breakdown between the U.S. and international markets. In the U.S. market, revenue decreased from $525 million in Q1 2025 to $492 million in Q1 2026, representing a decline of approximately 6.3%. This indicates a slowdown in revenue growth within the North American market. Turning to international markets, revenue saw a significant increase from $104 million in Q1 2025 to $122 million in Q1 2026, marking a substantial growth of about 17.3%. This robust growth in international markets is a positive sign and is expected to be a key driver for future company expansion. Looking at the U.S. integrated care members chart at the top, we see a slight decrease from $102.5 million in 1Q25 to $101.2 million in 1Q26. This trend could be interpreted due to various factors such as increased competition or seasonal effects. The average monthly revenue per U.S. Integrated Care member graph below shows that the average monthly revenue remained stable at $1.27 from 1Q25 to 3Q25, then rose to $1.34 in 4Q25 before slightly declining to $1.30 in 1Q26. This revenue fluctuation, along with changes in member numbers, suggests shifts in service utilization and product mix. The BetterHelp paying users chart in the upper right corner shows a consistent decline from 397,000 in 1Q25 to 361,000 in 1Q26. This may indicate sensitivity to external factors like the emergence of competitors or changes in marketing strategies. Finally, the chronic care program enrollment chart in the lower right displays a steady growth trend, increasing from 1,151,000 in 1Q25 to 1,197,000 in 1Q26. This is a positive indicator demonstrating increased demand for chronic care management programs and the company's successful service expansion. In summary, while integrated care membership is stagnating or slightly declining, chronic care program enrollment is growing, and the average revenue per integrated care member shows volatility, highlighting the need for a detailed analysis of each business segment's performance for future growth strategy formulation. This chart displays the quarterly adjusted EBITDA and adjusted EBITDA margin. The purple bars represent the quarterly adjusted EBITDA in millions of dollars, while the blue line indicates the adjusted EBITDA margin percentage. Observing the data from Q1 2025 through Q1 2026, adjusted EBITDA shows a steady upward trend from $58.1 million in Q1 2025, peaking at $83.8 million in Q4 2025, before declining to $58.2 million in Q1 2026. The adjusted EBITDA margin follows a similar pattern, starting at 9.2% in Q1 2025, climbing to a high of 13% in Q4 2025, and then dropping to 9.5% in Q1 2026. These fluctuations in metrics suggest changes in the company's revenue growth and profitability, allowing investors to assess the company's financial health and operational efficiency by analyzing these trends. This slide summarizes key indicators of the company's financial health. First, cash and cash equivalents as of March 31, 2026, stand at $751 million, representing the company's short-term liquidity. Next, convertible senior notes amount to $996 million, indicating a potential debt burden. Looking at operating cash flow, it was $10 million in the first quarter of 2026. This figure reflects the cash generated from the company's core business operations, and it's crucial to analyze its sequential changes. Finally, free cash flow for the first quarter of 2026 is negative $26 million. Free cash flow represents the cash remaining after a company has met all its operating expenses and capital expenditures. A negative figure here suggests that the company is currently expending more cash on its operational and investment activities. This financial overview provides crucial information for investors to comprehensively assess the company's financial stability, debt management capabilities, and cash-generating power. This table presents the outlook for the second quarter and full year of 2026. First, let's look at revenue. For the second quarter of 2026, revenue is expected to be between $597 million and $626 million, indicating a year-over-year growth rate ranging from a 6% decrease to a 1% increase. For the full year 2026, annual revenue is projected to be between $2.481 billion and $2.576 billion, with a year-over-year growth forecast between a 2% decrease and a 2% increase. Next, regarding net loss per share. For the second quarter of 2026, the net loss per share is expected to be between $0.30 and $0.20. The year-over-year growth is marked as NM, not meaningful, making a direct comparison difficult. For the full year 2026, the net loss per share is projected to be between $1.05 and $0.75. Now, let's examine the adjusted EBITDA. In the second quarter of 2026, adjusted EBITDA is forecast to be between $55 million and $67 million, showing a year-over-year growth fluctuation between a 20% decrease and a 3% increase. For the full year 2026, adjusted EBITDA is projected to be between $267 million and $306 million, with an expected year-over-year growth of 5% to 9%. Finally, let's consider the U.S. Integrated Care members. For the second quarter of 2026, the number of members is expected to be between 98.5 million and 100 million, with a year-over-year growth forecast between a 4% decrease and a 2% increase. For the full year 2026, the outlook is for 97 million to 100 million members, indicating a year-over-year growth range from a 5% decrease to a 2% increase. Overall, revenue is positioned within a range that could see a slight increase or decrease, while profitability metrics like net loss per share suggest potential improvement. Adjusted EBITDA shows a somewhat positive growth trend, and the number of members is expected to continue its steady increase. The table you are currently viewing details the reconciliation of GAAP net loss to adjusted EBITDA. In Q1 2025, the company reported a net loss of $93,012,000, which was adjusted to an adjusted EBITDA of $58,093,000 after considering various items. It's important to note that expenses such as interest, depreciation, amortization, restructuring costs, and stock-based compensation contributed to reducing the reported loss. Particularly, while the net loss in Q1 2026 increased to $63,837,000, the adjusted EBITDA decreased from the previous quarter to $58,169,000, serving as a crucial indicator for understanding the company's underlying operational performance. This allows investors to assess the company's core earnings power, excluding non-cash expenses and one-time items. This slide details the reconciliation of GAAP net cash provided by operating activities to free cash flow. For the first quarter of fiscal year 26, the company generated $9.516 billion in net cash from operating activities. However, capital expenditures amounted to $1.660 billion, and capitalized software development costs were $34.162 billion, both representing outflows of cash. When accounting for both of these, total capital expenditures, or CAPEX, reached $35.822 billion. Consequently, the resulting free cash flow for the first quarter of fiscal year 26 was a negative $26.306 billion.